All right, let's talk about a single number in real estate that can literally make or break a deal. It's a metric that lenders are obsessed with, but, a lot of investors just completely overlook it. It's called break-even occupancy, and we're going to dive right in. So let me ask you something. You're looking at an office building, right? And the broker tells you, hey, this thing is 90% occupied. Sounds like the slam dunk, doesn't it? A solid, stable investment. But is it really? Well, not so fast. That building that looks so safe on the surface, it could be teetering on a financial cliff. It could be just one tenant leaving away from losing money month after month. How on earth is that possible? Well, let's find out. This brings us to a really critical mistake, something you could call the occupancy illusion. Just because a building looks full doesn't mean it's actually financially healthy. See, physical occupancy, it only tells you part of the story. We need a much better tool, a sharper metric, to really get a handle on the risk here. And that tool is break-even occupancy. Honestly, the best way to think about it is like a financial safety net for your property. It tells you exactly how far things can drop before they get really, really dangerous. So what is it exactly? Well, here's the crucial point. Break-even occupancy is the exact percentage of your building that needs to be rented out just to pay the bills. We're talking property taxes, insurance, management fees, and of course, the mortgage. It's your financial 0 point. You're not making money, but you're not losing it either. And here's how you figure it out. The math is actually pretty straightforward. You take all your operating costs, add your debt service, which is just a fancy way of saying your total mortgage payments for the year, and then you divide that total by your gross potential rent. And that's just the absolute maximum rent you could possibly collect if the building were 100% full. Okay, let's make this real. Using a classic office building example from the material we looked at, the calculation spits out this number, 75%. So what does that mean? It means 75% of that building has to be occupied and paying rent, just to break even. Every single dollar you collect above that 75% mark is profit. But below it, oof, you're in the red. Now, this is where it gets really interesting when you visualize it. If our building is currently 85% full, and we know our break-even is 75%, that 10% gap between them, that is your safety cushion. It's your margin for error. It tells you that you can afford to lose 10% of your occupancy before you start bleeding cash. And that safety cushion we just talked about, it's not just important for you as an investor. It's the one thing banks and lenders focus on relentlessly when they're deciding whether or not to give you a loan. A lender looks at that 10% cushion we just saw and thinks, that's a little tight. What they really want to see is a much wider gap, usually somewhere between 15 and 25%. And why is that? It's because a small cushion means a small dip in the market or one major tenant deciding to leave could put the whole property and, more importantly to them, their loan, at risk of default. And this just brilliantly shows that not all properties are created equal. You look at industrial properties, they often have the lowest break-even points, maybe 60 to 75%, because their day-to-day operating expenses are just typically lower. But then you look at office or retail buildings, and their break-even points can be much, much higher, especially if they don't have what are called triple net leases. That's just a lease where the tenants pay for most of the big expenses, which lowers the landlord's costs and, you guessed it, lowers the break-even point. Okay, so you've got the basics down. Now let's level up and get into some pro-level analysis here. Because to really master this metric, you have got to know how to avoid the common traps. So the first trap is a big one, confusing physical with economic occupancy. A space might have a lease on it, so it's physically occupied. But what if that tenant got a sweet deal with 3 months of free rent? Well, for those 3 months, you're not collecting any income. Your economic occupancy is the only number that actually matters for your calculation. Next up, you need to understand how this relates to another key metric, the debt service coverage ratio, or DSCR. Really, they're just two sides of the same coin. Break-even occupancy tells you how much vacancy you can handle. DSCR tells you how much your cash flow covers your debt. Here's a great rule of thumb. When a lender says they need a minimum 1.25 DSCR, what they're really saying is they need your break-even to be no higher than 80%. And here are a few other quick pitfalls. First, always calculate using the actual rents being paid, not some pie-in-the-sky market rent you hope you can get someday. Second, remember the denominator in the formula is gross potential rent, so don't accidentally double count by also subtracting for vacancy. And finally, keep in mind this formula doesn't account for huge capital projects, like a brand new roof. Your real-world cash flow needs a separate cushion for those big expenses.
So after all that, what's the big takeaway? How can you use this to quickly size up a deal? Let's boil it all down to a super simple framework. Here it is. This is your cheat sheet. A break-even below 70%, that's a fortress, very conservative and safe. 70 to 80% is a pretty moderate and healthy range for most properties. Now, once you start creeping into that 80 to 90% zone, things are getting aggressive. There is very little room for error. And anything over 90%, that's just dangerous. You are living on the absolute edge.
So the next time you drive past a building with a for lease sign, you're not just going to see an empty window. You're going to see a hidden number. And you'll know that the most important question isn't how full is it, but what's its break even? Thanks for joining this explainer.